Okay, so welcome to the next section where we will learn about technical analysis. So I'm sure many of you would be aware of certain concepts of technical analysis and maybe are already using it to conduct an stock analysis using price charts and indicators. Even if you don't have any idea about the subject, don't worry, we'll cover all the basics. And my attempt here is to actually build a strong foundation for our study of the subject of technical analysis. So as you might remember this chart from earlier section of market cycles. So just like any market or just like any other commodity, the price of a stock is a result of demand supply economics. So when the demand is greater than supply, prices go up. When the supply is greater than demand, prices come down. So technical analysis is required to determine the demand-supply relationship and to understand who is in control. If the buyers are in control, that means the demand is higher. If the sellers are in control, that means the supply is higher and the price tends to act accordingly. So this can be done by studying price action, volume and time. So basically we have to study the relationship of price with volume. Volume means the number of shares being bought and sold, and time, which basically means which could be anywhere from a weekly time frame to a 5-minute time frame. The stock's ongoing cycle is the single biggest parameter of risk management. So why the study, another reason why the study is very important is that we need to understand where the stock price is in this cycle. If you are buying something here, the risk is very low. So in case you are wrong, you can obviously exit very near to your entry price. But if you're buying something here, this entire space is your risk. So the odds of success change dramatically based on where you buy in this cycle. So that's why you have to manage your risk differently. We will cover risk management in detail. By risk, I basically mean how much capital you are allocating, and in case you are wrong, how much will you be losing. So that's risk. Now, to understand how price moves, we can think of it as an auction process. So, what happens in an auction? In an auction, if more people are interested to buy something, the price of that particular thing tends to rise. And in case no one is interested, the price tends to fall and it will fall till it can find someone who is willing to buy at a lower price. And when it's rising, it will rise till it finds someone who will is willing to buy at the highest possible price. Okay, so with this understanding, let's look at the three stages that the market typically is in. So the first stage that we'll talk about is it's a stage of balance. So markets always want to be in a state. So the first stage that we will discuss is the state of balance. So markets always want to be in a state of balance, that is demand equal to supply. So what this means is that price will always move towards an area where facilitation between buyers and sellers can be easily done. So that is what we call as a state of balance. So in a balanced state, price tends to stay within a range. So over here we can see, so basically this chart is a much better representation of how price tends to move. It's very similar to what we saw in the previous slide. This is the accumulation phase, the markup phase, the distribution and the markdown. So here we can see a trading range or a range that is formed by price, and this can be easily identified as a state of balance. The second is the trending up. In case market balance is broken and demand is greater than supply, that means there are more buyers in the market than sellers. Everyone wants to buy and not enough people want to sell. So price will obviously start moving up. As price moves up, it attracts more buyers. Okay, so as price moves up, they attract more demand, and markets tend to remain in this state of imbalance. And in this case, because demand is greater than supply, it's trending up. So over here we can see that market breaks this balance and starts moving up, which tells us that demand is greater than supply. And over here you can see there was a temporary halt, but because this rising prices attracted more demand, price continues on its upward journey. Now the third state is the trending down state. So in case market balance is broken and supply overtakes demand, we will see prices moving down. As prices move down, just like the earlier case, they attract more supply and markets tend to remain out of balance and trending on the downward side. So over here we can see that another balance was formed. So accumulation and distribution are basically balanced phases, and where demand is equal to supply, and out of this balance, instead of breaking up, price actually moves down. So that means at this point supply overpowers demand. There are more people who are willing to sell than who are willing to buy, and price in its search for balance starts moving down. Over here it finds this temporary space where it finds balance, that means supply is equal to demand, but because of this price move, it is more people are willing to sell, and the imbalance continues till price forms balance again. That means now supply is equal to demand, and we can term this as accumulation because after this stage prices moved up. So anytime any state of balance after which prices move up is termed as accumulation, and any state of balance after which prices move down is termed as distribution, because all the activity that happened within it led to a decline in prices, and all the activity that happened within this led to a rise in prices. So over here we have some real examples. This is a chart of Tata Motors on a weekly time frame. So here you can see that from into this is 2007 till 2008 up till mid of 2008. So prices actually did nothing. They stayed in this range of 130 to 160, and they just moved up and down, up and down, up and down, up and down. So we can say that this is a balanced state till one day they finally started to move down, and we can see that this is a trending stage, trending down stage, and they took a halt there, but all this downward movement attracted more supply, and prices continued to move down till they again formed a state of balance. So price is always in a search of balance, but in between it keeps either trending up or trending down based on the supply demand economics of that time. Here's another example of HDFC Bank. We see that between 2015 to mid of 2016, price was actually between about 475 to 575. Stayed there for a year, and then it finally broke on the upside, and then it continued to move up in its search for balance. So this is a trending up phase, this is a balance phase. Now over here after balance price moved down, so this is a distribution phase, and over here after balance price moved up, so this is an accumulation phase. So now how do we actually analyze the price, volume and time relationship? For this purpose we use something known as charts and candlesticks. So to start our discussion, let's first understand what is a chart. So a chart is a graphical representation of price movements and volume of a stock or any stock over a certain period of time. It is used to study historical price changes or movements. For our purpose, we will be using candlestick charts. So charts can be of many forms. Over here I have two examples. So first is this is a line chart which basically traces the change in price over a period of time, and it basically plots that as a solid line. The other one that we will be using is a candlestick chart. So over here what it does is it traces one unit of time, in our case, which is 1 week. You can obviously 1 week as one candlestick, and then the along the time axis, as each week passes, a new candlestick gets formed, and which actually captures the change in price move. So a candlestick in basically in candlestick charts, the price movements for each unit of time that we are measuring are represented in the shape of a candlestick. Example, on the weekly chart, 1 week is represented as 1 week, one candlestick, just like that. So this is a weekly chart, and each candlestick over here represents 1 week of price action. So what is a candlestick? So the basics of a candlestick you can see over here. Candlestick is basically a charting technique which was invented in Japan very long time ago. If you want to read more about it, you can very easily Google and find out more details. But to cover the basics, over here you can see that red signifies price moving lower, whereas green signifies price moving higher. The candlestick has a body, which is this solid portion, and it has a wick. So the design of this candlestick will change based on how price has moved during this week. So how is this actually formed? So in this case, because it is a red candle, that means price has moved lower. So the starting of the body is the opening price, and the closing of the body is the closing price for the week. So you can imagine this, if you want to imagine this as a line, basically price moves, one second. Yeah. So we can say that on Monday morning, price opened here, it moved up, and then it moved down during the week. Then on Friday, it closed somewhere here. So this part becomes the body, and this additional part is the wick, and in this case price has moved down. So this is a candlestick. Similarly, in this case, since it is a green candle, that means that at the start of the week the price was lower and it has closed higher. So assuming on Monday price was here, then it moved lower, then it moved up, then it closed somewhere here. So this is the body, and these are the wicks. So wicks are basically overshoots between opening and closing, and in this case price has moved up. So for different, basically in the chart we will see with examples that different type of candlesticks are formed as each week passes, and the structure of the candlestick basically talks to us and tells us how the price action for the week played out. So for our purpose, we need to identify wide range candles which signify strong demand or supply. Okay, so candlesticks can be of many forms. I have some examples over here. So this is a wide range candle. Basically, a wide range candle is a candle which has a very long body and a very small wick, either on the upside or on the downside. So this is a green candle. Price opened here, closed here, and there are very small overshoots. In this case, price closed up, down, it opened here, closed here, and we have very small wicks. This is a narrow range candle. So over here you can see that this is the price opened here, closed here, but it went all the way up on both sides. So the body of the candle is very slim. So we can call this as a narrow range candle. In this case also, price opened here, closed here, and then we have long wicks, but the body of the candle is very slim. So this is also a narrow range candle. So basically, a bullish candle or a strong candle denotes strong demand or supply. Okay, so these are candles which kind of show that price moved one way without much resistance or without much counter force. So these are the candles that we want to identify on a chart, because this they very strongly tell us that the equilibrium is shifting or is not. So basically it tells us that price is not in a balance, and either one of the participants, either the buyers or the sellers, is trying to control the price. So this is a bullish candle. You see price opens here and then it closes right at the top at the wick. There is no wick also here. There is no wick. That means people were buying right till the close, like right till Friday 3:15, 3:20. People were trying to buy this candle. So this is also a bullish candle. There is some wick on the top, but you can see right from the word go, the price never went down and it moved straight up to close near the top. Over here you can see this is price opened here, it tested lower levels, but then at the end of the week it closed right at the top. That means people were buying right at the close on Friday. I'm talking about weekly candles here. Same with bearish candles. This shows a very strong bearish candle. People were selling right into the close. Again, price did move up a little, but it got rejected and people were selling right into the close. Here also, we can see that people started selling. There was no test on the upside, and prices continued to move down. Here some buyers came, but still we can see that the body is large, and this can still be termed as a very bearish candle. I hope this is clear. If not, then we can always discuss this later in the doubt section, because this is a very broad topic. But for our purpose, I am not going into candlestick patterns and whatnot. There are, if you guys are interested, you can read about it. But for our purpose, all we need is to find wide range candles. So we'll keep. So over here we have a chart of HDFC Bank on a weekly time frame, and we will attempt to analyze the candlesticks and try to identify wide range and narrow range candles. So over here I have marked a bunch of candles which, as you can see, are very narrow in range compared to other wide range candles that were formed on this chart. So see, this is a wide range, this is a wide range, this is a wide range, this is a wide range. Now when you compare this width to candles of like this candle, this candle, this candle, so these are all very narrow range candles. So narrow range candles are generally formed when price is in a balance and there is no overwhelming pressure from either buyers or sellers. So that's not a stage where we want to participate. So we'll just right now we'll identify, and but we have to understand that that is the reason why we are actually looking for only wide range candles. So over here we see that price actually moved down with a wide range bearish candle, but quickly it was countered by this wide range bullish candle which started taking price up. And then there was another wide range bullish candle, another wide range bullish candle, then a few narrow range candles. Price went temporarily went into balance, then one more bullish candle took price up. Then we saw some wide, so this is a wide range bearish candle, this is a bearish candle, but it formed a big long wick, so it's not really very bearish. Then again price started going up on back of wide range bullish candles over here. So basically wide range candles lead to movement of price. either up or down, whereas narrow range candles tend to, like this, tend to keep price in a state of balance. That's why it's very important for us to learn how to identify wide range candles and how to distinguish between narrow range and wide range candles. So now continuing our discussion of price, volume and time. So price on its own has no meaning. Price of a stock today can be 500 rupees, tomorrow can be 600, day after can be 400. On its own, it does not mean anything. It is only once we understand the underlying demand or supply at a particular price can we give any meaning to it. By what I mean to say is that when the price is at 500, is it moving up or is it moving down? That means we can identify whether market participants are willing to buy at that price or willing to sell at that price. So hence we can give some kind of significance to that price. So it's only the intensity of the movement of price in time or the rate of change of price in time that defines whether something is in demand, supply or in a state of balance. So this is the real purpose of technical analysis, to be able to identify whether a particular price is in demand, supply or in balance. So next is volume. Volume is the force behind price movements. We generally want to see high volume supporting price movements. So that gives us much more confidence that the movement is actually coming on back of real demand or supply. So here we can see that the ideal state is when the volume is high, the price movement is strong or high, and the verdict for in such a case would be strong demand or supply. Sometimes you'll see strong price movement, high price movement with the low volumes. So that can be termed as moderate demand or supply. Sometimes you want to participate with that, but most of the times you don't want to. Because only when there is strong demand and supply backing the price movement, it tends to last much longer. So over here we have price moving up with wide range candles and high volume. So over here you can see price, this is a wide range candle, this is a wide range candle, this is a wide range candle, and all these candles are supported by a rise in overall volume. So this is a good move which will most probably lead to a trending phase. Over here we have price moving down with wide range candles and high volume. So see, this is a wide range bearish candle, wide range bearish candle, wide range bearish candle, and over here we can see that, see this volume when compared to these three is starting to rise. This is also high volume, high volume, high volume. So high volume and wide range candles lead to sustained trending movements, either on the upside or on the downside. So understanding price volume relationship. So price basically defines the trend and volume tells us the underlying strength or weakness of the trend. So basically price and volume should be able to tell us the full story, whether something is in demand, supply or balance. And basically this movement is the, what we can say, the footprints of smart money in the market. So when we have price moving up on back of volume, that means that big money or institutional money is flowing into a stock. Similarly, when we have movement on the downside with wide range candles and volume, we can say that smart money or institutional money is exiting or moving out of the stock. Now the next part of technical analysis is called trend analysis. So price movements are not at random and markets are always in a broad trend, and it is very important for us to be able to identify the ongoing trend of the market. So markets tend to remain in their ongoing trend unless there is considerable changes in the demand supply economics. Price also doesn't move in straight lines, but rather it moves in waves that have distinct highs and lows. So at any given point in time, the price of a stock or an index will either be in an uptrend, downtrend, or moving sideways. So let's start by first understanding how what is an uptrend and how we can distinguish it. So the main characteristics of an uptrend is the rising prices with which are forming higher highs and higher lows. So over here, so you would think that price moves up in a straight line like this, but that is not true. Price always moves in steps. So if you want to imagine price moving, you can think of it like a staircase where price goes up, then it takes a pause, goes up, takes a pause, goes up, takes a pause. So this is typically how price moves, and in uptrend, price will move up, take a pause, move up, take a pause, move up. So these pauses are called pullbacks, and they can either be downward sloping or sideways. We'll discuss that. So basically the main characteristics of an uptrend is rising prices which are forming a structure of higher high and higher low. So you can see here that this high is higher than this high and this low is higher than this low. So in an uptrend, price always continues to move in this structure, forming higher high, higher low, higher high, higher low. Okay. So now when will a trend change? A trend only changes when this structure gets broken. So suppose the market now moves down, goes back up and moves down. So now you can see that the market was this high, it was unable to make a new high but actually made a equal high. And over here this low, market did not break it nor did it close above it, and this was the low and it made a equal low. Then it moved up and then it started moving sideways. So when the highs and lows become equal, we say that we are in a sideways trend. This also, when we talked about balance structures in the market, balance structures are basically sideways trending markets. Now again, if price has to break down from here and then it goes up and then it comes down. So here we have a low, here we have a high, here we have a high, and here we have a low. So here market has formed a lower low, and here market has formed a lower high. So these are the characteristics of a downtrend, and the downtrend typically continues like this, where the market keeps forming lower high and lower low, again lower low, lower high, until this structure gets broken, and then market again forms a equal low and a equal high. Here again we enter a state called sideways trend. So markets at any point of time are always moving from uptrend to sideways to low, downtrend to again sideways, then maybe here again it starts moving up, or if it wants it can start moving down into a downtrend or an uptrend. So this is how the market structure is always transitioning from one of the three trends. So over here I have a daily time frame chart of Reliance Industries, and this I think is from 2017 February up till 2019. So let's try to identify the trends as they play out. So over here we can see that the price is moving up, and then this is a high, this is a low. So at this point we have marked this high and this low. then price breaks out and forms a new high, and then it comes up and forms a new low. So once this is formed and price breaks out of this zone and forms a new high at this point, we can confirm that we are in a uptrend. As you can see that price has moved up, and then it continues to move up, forms a higher high, and then forms a higher low. So we continue to be in that uptrend, then another high, another higher low. So this low you can see is higher than this low, another high, another low. So till now we continue to be in an uptrend. Then there is this violation of this low, but price actually did not close below the low, so we don't count this as a change in structure. Then after some time we see that this high is almost equal to the previous high, and then price again forms a slightly higher high, but this low again is equal to this low. So these are basically one equal high and one equal low. These are signs that the price might be entering the sideways trend now. Then again we form another low that is almost equal. So now we can mark this area as a sideways range or sideways trend. Then price continues to be in this area for some time, then this is the first time it actually made a higher low and then a higher high. Now at this point, if the price is able to make a new higher low and a higher high eventually, we can term that the structure actually has moved from sideways trend into again the upward trend. So this is a higher low and then price moved up. We can mark somewhere here higher high, higher low, and then higher high, higher low, higher high, higher low, and then this low actually gets violated over here and price forms a lower low and a lower high. So these are signs that maybe the structure is changing and now we are in a downward trend. Then another lower high and another lower low. So in this phase actually price now is in a downtrend. Then we see that price forms a equal high. But the lows are rising. So unless we form a higher high, we cannot say that the structure has changed. But we are clearly seeing here that the lows are rising, but the high has not changed. And then eventually when price moves up and forms a higher high, we can conclude that this was a higher low, this is a higher high, and we are again in a uptrend. So like this you can see in over 2 years price continued to move from uptrend to sideways to uptrend to downtrend to sideways to again uptrend. So that's typically how price moves. It's never in a smooth straight line. Price is always in a broader trend and price keeps fluctuating between the highs and lows. So these highs and lows are actually also called pivot points, and they are very important from the point of view of managing stop loss when you take an entry. So because as price moves up, for the structure to be, you want to be in if you are participating in a uptrend, you want to be present in the position or the trade or investment, whatever it is, till the point the structure is intact. So you will keep marking out these pivot points and continue to hold on to your position till none of them is violated. As soon as you see any kind of violation, like this is a violation, Over here there was no violation because it moved from uptrend to sideways to again uptrend. So there was no need to exit your positions. So that's why you have to keep a track of all these pivot points to know if whether the trend is sustaining or there has been any change in the undergoing trend of the market or the stock.